Yeah, hi everyone. So let's start the day. Good morning and good evening to everyone. Hope you and your family are doing safe in COVID times. Our best wishes are with all of you. Moreover, thanks for those who have joined today for the webinar on how AI is transforming the future of insurance industry. We have participants from all over the world, especially US and Canada is in majority because it's towards the US and Canada market. Those who have registered for the event and want to understand more on the subject from the quality speakers is the best platform which we have for the day. Now to begin with, let me introduce myself and the company to you so that you understand more on the same. My name is Nitin Naveen and I am Vice President Innovation and Strategy at AI CoreSpot. I'll be your host for the day. Further, I have been joined by my colleague Arvind Kannan and Naveen Kumar, who will also assist me in keeping the event lively. So thanks a lot to them for putting in hard work and making this one a huge success. In AI CoreSpot, our aim is to be number one AI-driven community all over the world. So we have started with US and Canada, and we'll slowly move on to other parts as well. We want the like-minded people like you to come and be a part of the same in supporting, growing, and make it a success. Our mission is to serve as a hub for information regarding Industry 4.0 technologies, which encompass and not limited to. I'll name a few of the technologies so that it's easy for you to understand. AI, ML, deep learning, robotics, blockchain, IoT, edge computing, analytics, 5G, drone, edge AI, digital twin, AR, VR, cloud, and so on. We'll continue to do industry-backed webinars and hybrid events. The knowledge repository will be made from reliable data through industry thought leaders, subject matter experts, and leaders in the making as well. We'll enrich the content through videos, blogs, podcasts, newsletters, and digital content to shed light on the ever-evolving industry. Request all of you to go through our website, aicodespot.io, for future updates. Also, please like our social media handles, which will keep you all updated on everything what we propose to offer in the coming months and years to follow. Today's event is one series of events which we have planned this month. Another one is coming up on August 27. That is a half-day virtual event. Same theme with power pack presentations and panel discussions themed around how AI is transforming insurance sector. We'll send you all, those who have joined, we'll send you all the details for that event as well. So please join us for great learning in store. There are lots more in store for subsequent months as well, with focus on manufacturing, telecom, IoT, and blockchain till December month. So request all of you to keep connected with us and enjoy the learning. Before starting with the day, I would like to highlight a few things so that it can set up the tone for the amazing learning and networking day. First, a special mention to our technology partner, Digit7, who has helped us in understanding our vision and supporting us to create a platform like this through which we can help our objectives. Their support is immense and we are there because of them. Some introduction about Digit7 to everyone so that you are aware of them. Innovation is the cornerstone for Digit7. Direction fills them with purpose and purpose defines structure. So the visionaries at Digit7 realized this a quarter of a century ago. And they have ever since provided organizations with the strategic innovation roadmaps they need to forge their futures. Innovation is their last name and disruption is their address. They create paradigm shifts in organizations with intuitive technologies, equipping firms to ensure accelerating change. Some of the products which they offer are Smart Express Store, e-commerce, Grab and Go, Edge POS, Admin Store Management, Smart AR, Delivery Pickup App, Digital Wallet, Drone Scan, Blockchain-based SCM, Label Monkey, Data Mink, Digital Twin. And their services which they offer are product engineering, innovation as a service, digital transformation, customer experience, and innovation design. You can go to their website, that is digit7.io, and understand more in depth. Also, thanks to all our community partners for today, which includes Care First, Blue Cross, Blue Shield. We have Fisher Consulting Group. We have Forest Lake Consulting and Air Worldwide. They all make this event a huge success. A special mention to speakers who are there with us, and the attendees of the event who have registered and came today to achieve their objectives through this forum. At the end of the day, if you gain few things out of this, our core objectives as a company will be achieved. Just to apprise you all, there will be few polls which we will be conducting throughout the day, and the same will be broadcasted to everyone. So as soon as you see it, kindly attempt at them. Lastly, if anyone wants to ask questions, which is very important, if anybody wants to ask questions, there's a menu option. Okay, so there's a hand button at the bottom of the screen through which you can raise the hand, come to the stage, ask questions to all the speakers after the end of their session, or you can type in the chat box. So there's a Q&A section. You can type the questions beforehand, and as the speaker finishes the talk, I'll announce the questions and I'll apprise them so that they can answer it. Hope everything is clear till this period. Now I'll quickly go through the agenda for the day and let you get introduced to the speakers and their topic, and we can start with the first speaker, that is Rick Khorana. So let me share the screen first. So hope every one of you can see the screen. So we will be starting in the next 5 minutes. So I'll quickly take you through the agenda, which is in front of you, so that easy for you to understand. So this was the insurance event, which is happening on August 27, and this is the agenda for today. So I'll first take you through the agenda for today, so that easy for you to understand. First speaker is Rick Khorana, Senior Director, Technology Products and Delivery, Care First Blue Cross Blue Shield. His topic is AI in the healthcare insurance industry. Then we have Frederick, who is the president in Fisher Consulting Group. His topic is gotchas and solutions in the AI approach to specialty lines insurance, E&O, D&O, EPLI, and cyber insurance. Then we have Craig Sims, who's principal for First Lake Consulting, whose topic is the life insurance digital continuum. Then we have Doug Fulham, who is director in AI Worldwide. His topic is AI, ML, and insurance. So this is the agenda. These are the 4 great speakers. Before starting, I'll just take you the agenda for 27th August as well. So we have Somil there. We have Jim from Neptune Flood, Levi's NLS. We have Leslie from Woodruff Sawyer. We have Ben from Penn Mutual. There's a panel discussion. We have speakers from Milliman, Etymology Consulting, Sun Life, Doctors Company, First Energy. Then we have Atul Vora, who's from Solera. Then Catherine is from NFP, and Daitrich is from Swiss Re. So this is the agenda for 27th, and this is the agenda for today. So I'll quickly hand over the honors to do the first talk to Mr. Rick, and hope you all will have a great time with him and a lovely session to all of you. Thank you, Rick. Over to you.
Thanks, Nitin. Good morning, everyone. Really excited to be here. It's really bright and sunny where I am. Hope all of you have good weather where you are. Before I start, let me quickly share my desktop here. I hope you can all see my screen. Nitin, can you confirm if my screen is up?
Yes, absolutely. It's perfect.
So real quick, before I go over my slides, just a quick overview of the things that I would be covering today. Because I am the first presenter, I would talk a little bit about the differences between AI, ML, and deep learning. Talk a little bit about supervised and unsupervised learning and the differences between the two, because these are the terminologies that you hear a lot. I'll talk about usage of artificial intelligence, all the use cases which are out there. My goal for today is to highlight the things in the healthcare insurance industry which are equally applicable to broader insurance sector as well, and not go too knee deep into the healthcare sector. Then I'll talk about some machine learning models that I and my team have implemented here at Blue Cross Blue Shield Care First. Starting with the claims adjudication using artificial intelligence, customer churn predictor, talking about the CSAT predictor and the other AI models that have been implemented, which are improving automation and efficiency. I'll end my presentation with the general overview of state of insurance in 2030, which will be fueled by artificial intelligence, and then I'll hand it over to Fred. So real quick, wouldn't go into much details, but just to give grounding to everyone, the differences between the artificial intelligence, machine learning, and deep learning. Artificial intelligence is a broader field of study to give machines human-like abilities to think and learn. It's the broader set. And within AI, we have ML and the deep learning. ML essentially stands for, or terminology is used for statistical models that can learn through examples without having to be explicitly programmed for each given task, which is the traditional way of programming and solving an issue. Deep learning goes a step deeper. Traditionally, when you talk about the machine learning models, you're talking about singular statistical models, which is not always true. There are more sophisticated machine learning models, but just for the simplicity and to help everyone understand, generally these are the singular models which result in the shallow model. But when it comes to deep learning, which is the terminology you would use when you have neural networks, you have a more complex layers or several layers of models which tackle more complex and nuanced problems. So deep learning is where the industry is now. But obviously, industry started from machine learning before we all graduated to the deep learning. Quick differences between the supervised and versus the unsupervised learning. This is a terminology that you hear a lot. So I thought it would be relevant for me to just talk about it. The biggest difference is the supervised learning. You have the labeled data sets. You have the examples, essentially. And the model learns from those examples and is trained during the training phase. And once the model is trained, model can use those label inputs and then predict an output. And the example of supervised learning could be image classification. As you see in this example at the end of the screen, you are training a neural network, the differences between cat and dog, and you'll feed this model multiple images, different images of cats and dogs, and make sure the model understands the differences between the two. And once the model is trained, then you can put a random picture for the inference of the model, and the model would spit out whether it's a cat or a dog. The unsupervised learning, on the other hand, you do not have the labeled data. You don't have the example. So you're just throwing the data to the machine or machine learning model, and the model is trying to make sense out of the data. Essentially, it's used to discover previously unknown patterns, right? For example, anomaly detection or clustering. So in this one, you are just sending the data and asking the model to find the patterns based on certain attributes or features which are fed into the model. Switching gears and talking about the AI in healthcare insurance industry. As I said, I'm trying to keep the examples relevant to the broader insurance sector. But this is not a comprehensive list of everything that people are either working on or where the technology and the industry is heading. But this is a list that should give you a feel on the things being done using AI within the healthcare insurance sector. Sales and marketing. So I've highlighted only few business areas to make it, again, as I said, relevant to broader audience here. So within the sales and marketing, the things you can do with AI is customer segmentation for you to understand the differences between your customers and use that information for targeted marketing, use that information for product pricing, product positioning. So those are some of the things you can do within the sales and marketing area. Customer service, that's where I've done a lot of work, is some of the things that come to my mind, the CSAT predictor model or customer satisfaction predictor model, which is something that I'll be talking about some more in subsequent slides. Then you have the next best action. You want to empower your service reps to know what sort of action to take when you have the customer on call. Another thing that's happening a lot in the industry is the sentiment analysis, which is once a call comes in, you have to predict whether the call was a positive, negative, or neutral experience for the customer on call. The churn predictor is a very important model, as we all know. and I'll talk about it. Churn predictor model essentially predicts the likelihood of a person or a customer jumping ships, essentially going to another vendor for the same product. Then the chatbots, I think we all have seen chatbots in action in some form or shape, something that's very common, used across the board. Call summarization, that's next frontier, if you will. Agents spend a lot of time in documenting what transpired during the call, and we want that function to be done using deep learning or neural networks, where it would just take the voice recording of the call, convert into text, and then summarize the call to save a lot of time for the agents that they can then spend to really have a more informed dialogue with the customer on call. Then you have the agent performance. Going into the claims, because again, this is another area which is relevant to most of the audience here today. Claims adjudication, I'll be talking about that. Within claims adjudication, there are several functions that I've done here in my job. Claims assignment and routing, a lot of aspects of that have been are getting automated using artificial intelligence. Some of the other ones are specific to the healthcare sector, the provider data gaps, episode-based payment, claims quality management, and staffing optimization is something that's more generic in nature. If you have seasonality, you know that you expect to get more calls during certain time of the year. You can create sophisticated staffing models using machine learning and AI that help you optimize and hire the staff as needed. The medical management, most of that are going to be specific to the healthcare sector. The few I want to highlight is the risk profiling, which I think is common. Regardless of what insurance you have, you want to have a good risk profile of every customer so that you can use that information for customizing the products, customizing the pricing, and having features that resonate with the person and make it highly customized for their individual needs. Then some of the other models listed here, which would be relevant in a broader sector, are fraud, waste, and abuse. Fraud is a common issue that happens across the board. Then there are certain areas within the IT, and same models will be applicable within the domain of cybersecurity, anomaly detection. Even in testing, I've used the machine learning to identify the test cases and minimize the number of test cases that you have to do for the test automation. And then in general, creating self-healing applications that can understand, identify what went wrong, learn from those experiences, and then identify the steps and execute them without any manual intervention. So this just gives you a broad overview of all the things which are possible. But as I said, not an exhaustive list. There are a lot more that's being done within the healthcare sector and the insurance sector. Switching gears and talking about the claims adjudication, it's an area where I have done a lot of work. A lot is happening within the industry. The work that I have done are more scenario specific, which means you identify the claims which fall under a certain category, certain bucket based on the information that you get on those claims. And then you create machine learning models to predict the likely outcome of how those claims should be adjudicated. And the reason I want to highlight that is eventually the industry is going to move away from the scenario or mission specific or purpose-built machine learning models to a more generic machine learning models for the claims adjudication that would use neural network and deep learning. The approach that we took, which I think is very relevant for everyone, when you the adjudication space, no model that you create can always predict the likely outcome with the certainty that you can just use that information and automate. So therefore, the approach we took is to create the buckets based on the confidence interval. And as opposed to just looking for the possibility of us automating everything. The goal was to automate where you can, where the model has a higher degree of confidence, where the results being returned by the inference model are accurate enough for you to just go in and do the automation, versus the ones where the results are there, they are accurate, but not enough for the automation to kick in. And as you can see, there are three colors in this graph. The first one is when the confidence is anywhere between 90 and 100. And again, this is, every business problem is unique, and you can apply the same principle to the business problem that you are looking to solve using machine learning. But the point is, you use the higher degree of confidence for automation, somewhere that's in between 50 and 90, because those results are still good enough, or you can make it 70 to 90 or 60 to 90, whatever makes sense for the business problem that you're trying to solve. And then at least display those results to the end users, right? Even if you're not doing the automation, just displaying those results and making them aware that this is what's predicted by the AI model can help with the quality of claims adjudication. And the last one is where the confidence level is low and you'll still continue with your manual processes that you do today. The goal is the first colored area you try to maximize. You want to have as many cases fall in that category with the higher degree of confidence so that it can be automated. And the goal should be over a period of time should increase, and you should design your ML model or AI model in such a way that there is a full quality feedback. That way it's constantly learning the new things that happen, but also constantly improving the quality of data, right? So that feedback model is critical. Some of the benefits that we saw with with this model that we rolled out, obviously it increased the order adjudication rate, resulted in faster claim processing, reduced manual work, improve the customer satisfaction, because now this then on the quality side, when we started working on this model, we were not sure if the model can be trusted to improve the quality or not. But we found that the quality of the machine learning model compared to the manual adjudication is way superior. So as a result of this, we saw an uptick in the quality as well. In addition, as I was saying, that having a feedback loop is critical. So we started leveraging the results from the model to identify the gaps across the organization in the data, and started working with the business areas to improve those data gaps as well. And then it improved the operational efficiency overall. Another model that I've done a lot of work is the customer churn predictor. This model is used in various industry, and I think all of you know the cost of acquiring a new customer versus retaining a customer acquisition cost is always way higher. So retention is a big deal. Retention matters no matter what industry you are in. And this model essentially takes lot of information about the members, because again, this is healthcare insurance specific model, but the same concept you can think about no matter what insurance industry you talk about. And it takes information from the calls we have received from the member, the claims, any additional data out there, the demographic information, to predict the likelihood of the person leaving and switching carriers. You can use this information to then, devise targeted outreach strategies to retain a member, work closely with your sales and marketing team, make sure this information is available within your customer service portal so that the agent is aware that if there is a person who is likely to leave or likely to churn, they can use different strategies to retain the member. There could be pricing strategies which could be tied to this. Again, we don't do that here in the healthcare insurance sector, but maybe applicable elsewhere. Another important thing that we observe is you can use that information to start creating heat maps, and you can identify if there are zones where you have more customers churning. and use that information for maybe conducting ways to again retain those members. Maybe if you want to figure out where to put your billboard, so at least you'll know which areas, the counties and the zip codes where you have more people churning, and you can leverage that information to be more targeted with your marketing and sales effort as well. This is another model where done a lot of work, again, on similar lines, a CSAT predictor model, customer satisfaction. The goal with this model is to qualify every single call that comes in and identify, based on the information, based on the supervised learning trained model, to identify how likely this member or customer on call is going to be satisfied with the call, and you use this information to improve, obviously, the CSAT score. The difference between some of the other models in this model is, when it comes to the CSAT score or CSAT predictor, you go into the realm of prescriptive analytics. So far you were just doing predictive analytics, which means you were predicting what needs to be done. With the prescriptive analytics, you are now prescribing the next best actions to the agent on the call, and what can they do to influence the customer on call. Obviously, you can use this information to not only improve the member retention rate, or you can also improve the agent performance, because you can identify if there are agents who do better with the CSAT than the ones who are not. And then, like on our side, we use the data from the surveys, from claims, enrollment, and the customer service calls and cases to train this model. One of the things that this model should do is it should give you the correlation between the factors that influence the CSAT score. That way you have a solid strategy to improve the CSAT score by influencing those factors. These are some of the other models that we have worked on, and I and my team has worked on. At the top, we have the duplicate claims processing, something that happens often. You get multiple submissions of the same claim, which often result in the duplicate claims, and those claims need to be denied. So we are looking to leverage the AI to eliminate the duplicate claims. That way, that reduces the work for the claims processors. Claims routing, I talked about it. Something, again, we have built few AI models that do the claim routing. Again, most of these models were purpose built for the given scenarios of routing when the claims require collaboration from a given area. And we obviously started with the ones which are the high ticketed items, and then moved to the ones with the fewer cases. This is, again, another thing where overall industry would evolve. And as opposed to having these purpose-built models, there would be more generic models that can automate all aspects of claims routing, but something, nevertheless, we have seen significant benefits from. Talking about another one, which is at the top, which is subrogation, applicable to the healthcare insurance sector. It may have some application on the broader insurance side as well, because in this one, we are looking for the other party liability. If there is an accident and the payment should come from your auto insurance company versus from the health insurance company. So the goal was to identify those scenarios. It uses a time series-based analysis, which means you have to analyze the claims for 3 months or 4 months to really identify the onset of an episode, and then create a lead, and then get sufficient information to convert lead into a case. Again, this was unique because of the time series component. Your episode is something that happens over a period of time versus something that you can deduce from a single claim. So there were some challenges, but something that we have successfully rolled out as well. And the last one is the customer sentiment analysis. This is, again, happening a lot in the industry. You want to understand every single call. You want to flag every single call based on the customer sentiment. You want to flag whether that was a positive, negative, or neutral experience for the customer on call. Obviously, it's good. The goal is to maximize the positive experience, right, and minimize the negative experience. So you can use this information to either train the agent or do an proactive outreach to the customer on the calls where they had a negative experience. So switching gears, we talked about some of the models that I got a chance to work on. But now I'll just end my presentation with the general state of insurance in 2030, because that would be relevant for the subsequent presenters to come in. Not talking about health insurance, I'm talking about insurance here. But again, some of these things are going to be equally applicable to the health insurance sector as well. So this most of the information on this slide comes from a McKinsey presentation where they talked about the state of insurance, how it's going to be in 10 years from now. 3 sections: distribution, underwriting, and claims. And it's obvious for us to conclude that AI will impact all aspects of the insurance industry, from pricing, distribution, to underwriting and claims. On the distribution side, most of the insurance what used to take several minutes for pricing a product and closing the deal can now be done within minutes, and goal is to take it to seconds. All that is possible because of granular risk identification based on AI algorithm, and you're gonna see a lot more movement in that space to identify and flag every single person. Then the pricing algorithms will use information coming from IoT devices for them to become more accurate. That way they know not only who you are, but what you do. The product offerings can constantly adapt to an individual behavior and pattern using the IoT information. Then on the underwriting side, again, a lot of work being done. There are models which are powered by not only the internal data that's available to each company, but they can also get the data from external sources and use that insurance, product manufacturers, product distributors, IoT information, and use all that to fine-tune the models. And a lot of differentiation will happen, not just based on pricing, but also based on experience, based on features, and the value, in the fact that some of these products can be hyper customized for your specific needs. Already talked a lot about claims. We talked about automation. I talked about industry moving from purpose-built models to more generic models that can pretty much take over all aspects of claims adjudication. Claims routing, something that I've done work on, already talked about it. Most of those business areas or business functions rather can be done using AI as well. IoT sensors will play a huge role in the claims adjudication process. Some of the onset of claim submission can even happen before an actual submission happens through the tracking of the IoT device. And there is going to be increased focus on risk monitoring, prevention, and mitigation. And so it's an exciting future ahead of us. AI is going to be there everywhere. It's already everywhere. So can't wait for us to get there. And with that, I'm going to end my presentation and hand it over to you, Nitin.
Thank you. Thank you, Rick. Thank you. I think it was a lovely, crisp, simple, and exciting presentation. Means you gave all the parameters of AI, machine learning, deep learning, supervised, unsupervised, and then you moved on to the flow of what you are doing in the insurance industry. I think it's fabulous. Thank you. Thank you, Rick. Anyone who wants to ask any question, they can type in the chat box. There's a Q&A option. You can type in case you want to ask any question. We have 1 minute. Otherwise, we'll move on to our next presenter, Frederick. Yeah, I think there is something. Okay. One question is there for Rick. Career point of view, what is future of AI? Because I'm non-technical background.
AI is here. I mean, look around all the devices we use, phones, automated cars, AI is here. If you want to make a career in AI, There are lots of resources available. You can use some free resources on Coursera. There are, tons of material. If you are a non-technical person who wants to use I think there is a career for you as well. Just being technical is not good enough, right? Just creating a model. A model is as good as the feature engineering which is done on the model. For you to identify a business problem and determine how AI can be used to help alleviate the concerns or the challenges that exist with the business problem. So I think it's equally important. People with the good industry domain expertise, I think, have a career in AI as well. And at the end of the day, that expertise determine how successful your AI model is going to be. It's not about, just hiring the best data scientist. A lot of those functions are getting automated. You don't have to write sophisticated algorithms. It's about doing the feature engineering. Hope that answers the question.
Thank you, Rick. I know it's a general question, and it's not related to insurance or any per se. I think anyone can give their viewpoints also when they feel like Frederick can also give the viewpoint after the end of the presentation in case he wants to talk about what is the future of AI. I know it's something Frederick is very skeptical of, and he can throw more lights on this. Thank you, Rick. I think all good to go for Frederick's presentation. Thank you, Rick, for the lovely one. We'll stay connected. Thank you.
Good morning, everyone.
So, over to Frederick. Yeah, Frederick, please. Thank you.
You see my screen? You got it?
Yes, absolutely. Yeah, I can see that.
All right, I'm not going to scare anybody with my background for quite a while. Just let it be said that I'm a firm believer in automation. My companies were networked in 1984. We developed our own claim tracking and in a relational database by 1986. I think in 1998, we were able to use DSL, which at the time was really high speed, to submit applications to insurance companies. We were binding accounts before my competitors could even clear them. And in 2000, launched a fully interactive website that kind of set the world on fire at that point in time. All I can tell you is I'm cursed with being an early adopter. And unfortunately, that also leads to the conclusion that sometimes you can be fed to the best lions. Nonetheless, one of the things that I'd like to point out that many of the speakers today and later in the month are focused on first-party coverages and medical insurance and what have you, and where artificial intelligence is making tremendous headway. And you're also seeing it, of course, in the casualty business, which is my area of expertise. So from that perspective, when you're dealing with casualty losses and litigation, which is my playing field, my specialty has been in professional liability and specialty lines, director and officer liability insurance, employment practice insurance, fiduciary liability insurance for employment benefit programs, professional liability of all kinds, and cyber liability, of course. But all of these lines of insurance have something in common, and that it's very simple. What you're looking at here is the fact that whenever a product from an insurance company, no matter what it is, there is a basic assumption that, number one, the product's being sold to a consumer, and the only thing that they're buying is how that insurance company responds when they have a claim. That's it. And that's not a time when a policyholder wants to have a surprise. I can guarantee you that. And part of the problem is the fact that actuaries, when they set their pricing, they're certainly using historical data and other research, but they miss one important factor, and that is unallocated loss adjustment expense. And what that means is when an insurance company says you're not covered and sues you, and you sue them for bad faith, that's unallocated loss adjusted expense. Whereas in normal claim processing, there's cost of investigation, there's defense costs, and that data is included in the review process for actuarial pricing. But unallocated loss adjustment expense usually is not included. And that is a major flaw in a lot of actuarial analysis. Finally, of course, we have we have to worry about, does the product being sold meet the reasonable expectation of the policyholder? So that's an interesting problem. So what is the products that I've been involved with for the last 46 years? What is it really about? Number one, if the product is how the insurer responds, are they living up to the reasonable expectation of the policyholder? In other words, uncertainty is not a good thing. And these kind of policies that I've been involved with have a lot of uncertainties. In addition, when you eliminate that uncertainty, you increase the probability of a profit. And we're going to get into what I'm talking about very shortly as far as eliminating uncertainties. Profit becomes a result and not the original goal. Because if you live up to what the policyholder needs, you're going to eliminate a lot of unnecessary litigation. And what I'm getting at is this. If the actuarial analysis is based on a claim that's anticipated and expenses that are anticipated, then when you have unallocated loss adjustment expense put into that equation, you cannot make a profit. You are acting outside the actuarial model. And what I mean by that is you get a claim against the insured that's anticipated, but the carrier denies coverage for some reason. So now they have to file a declaratory relief action against the insured. The insured may file a cross complaint back against the insurance company for bad faith. Of course, you both can't be right. They may join the insurance broker on a malpractice case. So now you got 4 pieces of litigation arising from one anticipated claim. That's acting outside the actuarial model, and an insurance company cannot make a profit if they do that routinely and frequently. So in reality, how's that work in the real world? Well, making a profit, uncertainty increases costs and expenses. Uncertainty increases unnecessary litigation. And so, you can't make a profit if that's what you're doing all day long. Uncertainty can turn one claim against the insured into 4 lawsuits. And that is unsustainable. And frankly, it doom a program to failure. And anybody in the casualty industry can attest, how often have we seen an insurance company withdraw from a market after 4 years? A lot. But brokers like stability in the marketplace. They want an insurance carrier to stay in the business, line of business for a long time. And I'm sure, as we all know, there are very few that have. But making a profit should be a result, not a goal. So let's talk about some of the dangers that we deal with and that I've dealt with for years. Claim. Oh, my goodness. That's what triggers a policy, a claim, especially in professional liability, where we're not dealing with occurrence policies or an event that takes place during the policy term. We're dealing with a claim first made against the insured during the policy term. And because we're dealing with professionals, they may make an error yesterday, last year, 3 years ago, that results in a claim now. That's a claims made policy, and it's got a lot of problems. But the definition of claims are all across the board. There's no standardization. A claim could be a demand for money as compensation for a wrongful act, or it could be any judicial proceeding, a disciplinary proceeding, a mediation, an arbitration, etc. A claim could also be a request to toll the statute of limitations relating to a potential act. Now, these are all common definitions found in the claim-made policy. All of them. Problem is, guess what? Not one of them requires receipt by the insured. A demand for money may not have been received by the CEO. A judicial proceeding may not have been served yet. A disciplinary proceeding may not have been served yet. A request to toll the statute of limitations, well, that may have been received. But most of the policies today are written on what's called a claims made and reported to the company during the policy term. How do you report a claim that you haven't received or you don't know about? So the point is, a claim should be considered first made when the insurer's legal representative first receives notice of a claim. And you'd be surprised how many policies don't have that language, especially director and officer liability policies. They don't have that language frequently. And it's amazing to me, from major carriers sold by major brokers, that language is missing. So, claims made and reported, well, that's interesting. No coverage for a criminal investigation where the indictment was sealed. Let's think about that. You got a government action, which could be a definition of a claim. They have a secret grand jury that comes down with an indictment, and then the indictment's sealed. Now, the target of that investigation is a corporation for some reason. And guess what? Their D&O policy is triggered, and they don't even know about it. And a year or two later, when the indictment is finally unsealed and gets served, it obviously is way too late to report that matter to the insurance company. 3 decisions have already come down upholding the denial of coverage. 3, New York, New Jersey, and now 1 in California. So coverage was rescinded as well, where a lawyer embezzled from the fiduciary and trust account of the law firm. And of course, as many of you may know, when you sign an application, there's a warranty question, and maybe even a polling requirement. Have you asked every member of the firm, are you aware of anything that could become a claim? And everybody says no, including the embezzler, because what do you expect him to do? So raise his hand and say, oh yeah, I just stole $450,000 out of the fiduciary account. Maybe we ought to disclose that. And good luck with that. And again, the denial of coverage was upheld, and worse, the appellate court ordered the policy rescinded. So now the law firm had no coverage at all. That's a major gotcha. And these are things to be considered. And another important reason why knowledge by the insured that a claim has been made, or an indictment is coming down, or a judicial proceeding is taking place, or an EEOC claim against you for some sort of employment practice problem. That's important. And people, unfortunately, are taking that language for granted. So I know we got limited time here. So we could spend all day on cyber exposures and cyber liability. Here are 10 costs that people mistake. Here are 10 costs and 10 types of claims rising from cyber exposures that most people mistakenly believe are covered. Financial loss during downtime. Like your computer's been frozen unless you pay a ransom. Losses incurred during a policy waiting time. Third-party mistakes. People that are handling your systems or programming or maintaining them. New hardware. And believe me, with Windows 11 coming out, a lot of people are going to be buying new hardware really soon because they're going to find their older computers are not compatible with Windows 11. Software upgrades, same thing. Glitch in the loading. Social engineering, including business email compromise attacks. This is a biggie. And already we've got conflicting decisions on this. There's an insurance company that has a cyber liability policy, and they said, no, you're not covered for, the president says we got to wire this money to so-and-so instead of at this address as opposed to the other address, and only to find out it was a hack, that it was wrong. And millions of dollars have been stolen that way. And the problem with that, we'll get to in a little bit, social engineering is wide open. Some policies specifically cover it. Some policies rely on how a court will interpret the policy, which frankly is the last thing you want, because that means you got to have a lawyer suing the insurance company. So in one state, they said it's not covered. Another state said it did. How do you reconcile the two? Same company, insurance company, same policy form. Bodily injury and property damage may or may not be covered. Be careful with that. Fines and penalties from a payment card industry. Reputational damage. Loss from account takeover schemes. Oh, yeah, let's not forget this one. Misappropriation of funds. Not always. Do not take this stuff for granted. And unfortunately, how is artificial intelligence going to deal with that when you're online filling out an application? It's the policy form, dummy. It's already set in stone. It's already been written. It's already been filed with the states for approval if it's from an admitted insurance company. If it's not admitted, who knows what the policy says? But you don't buy anything without seeing the policy first. Crime and theft is a big deal in cyber liability, and not every policy is adequately addressing it. And so here again, you have an example of a social media fraud. And the key language isn't, the fact that they're advertising, oh, yeah, we've got a broad definition of wrongful act, we got a broad definition of coverage, et cetera, et cetera. That's not the key language to worry about. And here's what happened with it. It's called authorized access. And now you're at the mercy of how a court wants to interpret authorized access. And that's where you got a difference of opinion. One court said, oh, no, it was authorized. Another court said, oh, no, the authorization came from a fundamental fraud that the president said, we need to have this money wired right away, right now, to this email address or to this account number, when it was totally wrong. And was it really authorized when it's based on a fraud? So that's the big deal. And you have to, be very careful. Some commercial crime policies are going to cover it. Some are not. So why was this particular claim denied? Same thing. Checks. Forgeries. Was it authorized? Was it not? So in this case, court didn't find any direction to pay. And it's similar in logic to unauthorized access. But what you don't want is to have to fight with an insurance company. You want to have a policy review up front in right away so that you can deal with it correctly. Other things to worry about, whether or not your policy is a duty to defend or a duty to indemnify. Does the insurance company have to reimburse you after the case is over for defense costs? Good luck with that when you got $700,000 or $800,000 in attorney fees, and the insurance company says, no, we're only going to give you $200,000. You want to really make sure that they have an obligation. If it's a duty to indemnify policy for expenses, that they have an obligation to make those payments periodically and not at the end of the case. So defense in addition to limits is another big deal. But now it doesn't always work. Here's some issues with respect to D&O coverage. If you want to hire a competitor, that may not be covered because it may be considered an unfair trade practice. So again, you have to be concerned about the policy language, which is set in stone, and not any artificial intelligence isn't going to be rewriting a policy live as you apply for it. Trade practices comes to mind right away and may or may not be covered. And in a D&O policy, don't take government investigations for granted because they're not always covered. And of course, there may be what are called side A alternatives, where an individual director may decide, I want my own policy, and it will act as excess over the corporate D&O policy. But on the same token, it may or may not be broader. It may or may not have the same coverage as the primary corporate D&O. So if an individual director buys a side A policy, he should get what's called the difference in condition form, the DIC form, which is generally broader. And then in that case, you're going to have a better chance. So that is another problem too. But the side A coverage should apply if for any reason the D&O carrier doesn't want to apply coverage to the primary. What else do you need to worry about? Crowdfunding. And I know that in the AI industry and in the tech industry, this is a big deal. But D&O doesn't always automatically cover that, especially when you've got SEC considerations. So you want to be ahead of the curve on this and know what you're buying. These policies are very, very complicated. In addition, you want to make sure that a public offering is later going to be agreed to. Some policies may exempt securities. They may be silent on them. Don't take any of this stuff for granted and work with a specialist. The same is true of future public offerings. And of course, bankruptcy is a big deal, and whether or not directors and officers are covered for that. There is an insured versus insured exclusion. A trustee that comes in and takes over the corporation in bankruptcy court may be considered an insured. But one insured cannot assume another. So for that purpose, there has to be a carve-out for it. And here's a good example of one. The insured versus insured exclusion will not apply to a claim by an examiner, trustee, receiver, etc. That's a carve back, and that's very, very important. And it's equally true in other lines. And of course, committees of a corporation are not always covered either. And that's another gotcha to worry about. That are authorized, fully authorized committees, are the members covered? And of course, a claim by insured debtor in possession, again, be careful with that. Cyber for D&O, director and officers policies do not explicitly exclude cyber claims. So there may be double coverage with a cyber liability policy, because often directors who sit on the board may be given the responsibility of supervising a particular department of the corporation. So now there's a failure to supervise issue. And that's where the potentiality comes in that this could be covered. But so far, most D&O policies are not excluding it. So regulatory investigations, fines that come about, these are all important. From an employment practice standpoint, never underestimate an exposure to American with Disability Acts. Law firms are suing corporations every day because their website is not ADA compliant. So, as you're talking to a computer online, that becomes an important feature. And these lawsuits have been increasing dramatically since 2017 and 18. 432 of them already, and this is increasing dramatically. So when it comes to employment practice, here are things to consider. Wrongful failure to promote, wrongful termination, breach of contracts, wrongful discipline, negligent training or supervision, employment-related invasion of privacy, negligent hiring, wrongful demotion, and who's an employee. It's a big deal, especially with all the gig economy things going on in Uber and others. That's something to be concerned with. Just who is an employee? And of course, the Supreme Court just shot down a law that was passed by the voters pursuant to a referendum. So again, be careful. These are not standardized policies. So you got to be really careful. China. I like this one. Additional insureds, you want a certificate, get a copy of the policy. In this particular instance, the policy was issued by an insurance company in China. So it didn't really do the policyholder very good, or the certificate holder to be an additional insured to somebody else's policy, only to find out that they had to get the matter or be covered in China. So good luck with that. So we're running out of time. So let's go to questions. What do we got?
Thank you, Fred. Guys, any questions?
Or did I scare everybody away, Knitting? Did we freeze? I think I'm frozen. Did I freeze?
No, you are there. Absolutely. I can see you, yeah. You can stop the screen sharing. Then you can see us.
Oh, okay. Where is it? There we go. Anyways, there we go.
Yes.
Any questions? Then I hope I woke everybody up because it's only 7:42 in the morning. I've been here from 6:15.
Yeah, it's 9:42 here and 10:42 in EST time. So I think it's good to go. So guys, any questions? There's a chat box. There's a Q&A section on the right side. You can type and you can ask Fred, and he will be happy to help. We'll wait for 1 minute, and then we'll start with, if no question comes, we'll start with our next presentation.
I'm sure I woke everybody up. In any event, if there are no questions, I want to thank everybody and Nitin for having me share some of these points of view, but don't take any of these policy forms for granted because artificial intelligence isn't writing these policies in real time.
Yeah, absolutely. You're right. You have to take calculated risk in doing all these things. You cannot be blindfolded and you just take everything in AI space.
Well, that's the problem with online systems. You don't get to see the policy in advance or the endorsements.
Yeah.
Yes. Don't want a surprise when you report a claim.
Yeah. At the time of claim, a lot of things pops up. And you're surprised.
That's not when you want to hear about a gotcha. I can guarantee you that. In any event, I hope the audience wasn't too bored. I hope I didn't go too fast. I want to thank Nitin again.
No, it was perfect. Thank you, Fred. And it's our pleasure to have you as a speaker as well. Thank you.
I'll turn it over to Craig, I guess.
Yeah, Craig. So we'll quickly move on to Craig now. So Craig is the principal, Forest Lake Consulting. His topic is the life insurance digital continuum. So over to you, Craig. Thank you.
Thank you, Nitin, very much, and thank you for tuning in. Hey, I'm going to focus on life insurance. That's my background. I was 18 years as chief marketing officer of a small life and annuity company, and integrated AI and AI concepts throughout the organization, especially during my last 4 years at this company. I left in 2019, so from 2015 to 2019, we launched both direct-to-consumer and digital agent environments utilizing AI along the way. I talk about the life insurance continuum. And what that means essentially is how it impacts the entire life insurance agent and customer experience, really from the inception of the sale, which means marketing and bringing people into the organization, into the top of the funnel, all the way to issuing the policy and post-issue. And our relationship with the customer post-issue now is also being driven by AI and AI concepts. But for the next 15 minutes or so, I'll focus on three key areas within the life insurance continuum: marketing and lead acquisition and how AI is impacting that. I'll spend probably more time on underwriting and risk management, even though I'm a marketing person. This is where AI is, I think, very useful as part of the continuum. And then certainly an area that life insurers, unfortunately, have not been very strong at, and that's post-issue nurturing. So once a policy is issued, how do you make sure that that person stays on board, right? Stays sticky, as they say, and also the ability to cross-sell and upsell. So since 2019, I've been consulting with life insurance companies and life insurance platforms looking to move from that analog environment to a digital environment. And certainly that includes areas involving AI. So with marketing and lead acquisition, more and more there's tools out there, AI tools out there. And part of this information came from a PwC India study that showed that identifying client behavior is a good indicator of whether or not they might be a life insurance prospect. And things like that are banking behavior. Are they opening up new accounts, meaning they're probably a younger person or a young couple? Driving and location mapping, where are they going? What are they buying? That might be an indicator of being a life insurance prospect. Certainly their social media presence, analyzing their photos and the context of those photos, though you might see wedding photos or baby photos as part of their social media presence, and being able to target that person with a life insurance offer when you see those indicators. These are all AI driven, obviously. Their retail purchases, there's ways to find out what people are purchasing and whether those are indicators for life insurance purchases. What their mobile and telecom behavior is, data from connected devices, right? Is this person fairly active? Can we capture that data from their wearable? And therefore, they're a good prospect because we want people who are active coming into the top of the funnel as life insurers. And then finally, pinpointing marketing messages and media by that persona. So all of these things help us create a persona and then pinpoint specific marketing messages really customized to that prospect, making personal offers. And AI can help generate that. The other trend, and you've probably seen it around, is making embedded offers based on purchases that indicate a life insurance need. The most obvious and the one that I was involved in, or at least my company was involved in for years, since we were a bank distributor of life insurance. So we had banks that were clients of ours, and the banks actually distributed life insurance right there in the branch locations. And early on, back in the 70s and 80s, even the 90s, there was something called mortgage life, right? And mortgage life was a partner product to a mortgage. So you sat down and were signing the approval papers on your mortgage, and the person sitting at the desk with you would say, boy, Craig, since you're getting a mortgage, why don't we just protect that mortgage with life insurance and add $14 a month to that? Is that something that we can move forward with? So that's an embedded offer. It's the person is ripe for this offer because they're getting some new debt, and of all the indicators that indicate whether someone is a life insurance prospect, certainly taking on new debt is one of those indicators, right? So new marriage, new debt, new children are all high indicators for life insurance purchases, and these people are ripe for life insurance offers. So the more modern way to do that, as opposed to in branch, is to identify those people who have received mortgages and then make an online offer through social marketing, through SEO, et cetera. And those could include baby care items, student loans, right? Any indicator that a person is going through a change where they're taking on more risk, they're taking on more liability in their lives, are all good indicators for life insurance. So that's the marketing and lead acquisition use case for AI. But where it's happening more and more is obviously in underwriting and risk management. And I think Rick mentioned, really in a different context, but really very similar, is engaging with more prediction confidence, right? So you need to make be more confident in your decision to underwrite someone on the life insurance side, and AI. Using all of the APIs out there, including electronic health records and pharmaceutical databases, motor vehicle databases, LexisNexis information, et cetera, are all synthesized into to help underwriters make a decision. And in fact, I think it was Deloitte who said that underwriters are changing their own personas, right? So underwriters these days, especially with the onset of APIs, are more, they call them data pioneers and risk detectives more than just underwriters. So I think this technology is not replacing underwriters. It's changing the role that they have within an organization to be more data analysts and making decisions based on the data that they have in their hand. One recent thing that I saw out there, I know one of the clients that I was doing some consulting for is they require an interview with a client before they'll approve a policy. And during this interview, they're using voice recognition to identify smokers just by the sound of their voice, right? And if this artificial intelligence identifies the person as a likely smoker, they're kicked out of the process and put into a full underwriting process as opposed to being made an offer outside of that. So AI is being used in those concepts as well. And obviously, it's being used in predictive risk scoring. There's a company out there called iCover. iCover is a modern underwriting platform using AI and machine learning for life insurance underwriting. And they are basically, the basis of their model is using predictive risk scoring through the use of AI and machine learning. I think the industry is changing to this AI model that demands that you also have the talent in your underwriting department that can be that underwriting detective, right? So the requirements of the talent as underwriters in life insurance companies is changing as the technology is changing. So other components that are available using AI is back testing and simulations to verify the results of your underwriting. And ultimately, what you want to be able to make more offers outside of traditional underwriting categories. So, someone said that there are no bad risks; there's just bad pricing. And I think that goes for life insurance as well as the P&C side. And I also noticed that Rick had another slide up there that was showing that ultimately what we want a certain percent of cases to be issued immediately, right? As soon as the person e-signs and agrees to background checks and APIs, then we're going to make an offer in real time. Another percentage might get an offer within 24 hours, right? The underwriter does some light underwriting, does some risk detective work, and within 24 hours, an offer is made to that person based on what we know, and then the remainder would receive full underwriting based on the information that they're capturing. But all of this is customized based on the applicant's very unique risk profile, all driven by AI. And finally, post-issue nurturing, referrals, purchases, a traditional weakness area for life insurers. Life insurers, unfortunately, we're very much in the mode of once we get a person issued, they will get a statement from us every year on their policy. And that's about all the communication that we're going to have. We leave the communication up to the agent. And unfortunately, depending on the skill of the agent and the desire for the agent to stay in touch with the customers, the home office would have to depend on that for ongoing communication. Well, what's happening now is AI is helping life insurance home offices to be able to stay in touch with these customers, right? For referrals, upsells, identifying primarily using historical and demographic data when another offer should be made. So a person who's 32 years old buys their first term policy. 5 years later, what we find out is this person bought a home and they had their first child. And that might be a good time to introduce them to the concept of whole life, right? And the value of whole life, especially as they start to earn a little bit more, they can afford to add whole life to that equation. Gaining referrals is a valuable tool that AI can drive as well. And then AI-powered chatbots for normal everyday communication can be the first contact with the customer while they're in force, and then only default to a contact center or to the agent when the AI chatbot can't manage the need of the customer. But this ongoing communication with the customer really can be driven by a bunch of things. It certainly can be driven by wearables, right? So one of the things we created at Vantis Life through our partners. So our partners that we used for moving to a digital environment were Surify, which is a pretty well-known platform for insurance, and their partner, which is Hanover Re and Hanover Re's Reflex underwriting tool. But what Surify helped us also put together was a post-issue communication and giving the client access to their information through an app on their phone. So right now I can go on my Vantis Life app and I'm linking my phone, rather my watch to my phone. They give me challenges for steps, for hills, for distance every day, and based on that, I can earn points toward retail purchases. So I'm connected that way, and AI is generating that. They're giving me AI articles based on my age and what they see on my watch, and I'm getting fitness articles and et cetera that are all based on what they know about me and using AI. So that's another way that AI is impacting. And then finally, AI can help agents interact with customers digitally, right? We're not removing the agent from any of these interactions. And in fact, what we're doing is we're actually emboldening the agent with information that they can use to contact the customer if that's the way the customer wants to be engaged, right? So there's a big misnomer out there that using AI and using digital platforms is excluding the agent, when in reality, if an organization is agent-centered with maybe some direct-to-consumer happening on the side, what we want is the agent to be selling, not to be servicing these products. So if service can be done using AI and digital components, rather than having the agent deal with everyday servicing issues, then AI is doing its job there as well. So I've covered three specific areas of the life insurance continuum. A lot more is happening in that continuum in areas like claims, which Rick mentioned, and other areas of that continuum, but that's a discussion for another day. Any questions?
We'll wait for some time. We'll wait for some time to people to just, in case any question is there. Yeah.
Thanks, Nathan. Appreciate it.
Thank you, Craig. Yeah. Thank you for the lovely presentation and the lovely thought process which you put forward. We'll stay connected, Craig, and we'll have you in the next few events as well. Thank you. So, guys, quickly we'll move on to our next presenter. So, our next presenter is Doug. He's Director AI Worldwide, and his topic is AI, ML, and Insurance. Over to you, Doug.
Thank you very much.
So I was able to see your presentation, I think. Yeah, it's coming here.
Okay.
Sure.
Thank you, everyone. I'll skip over my introduction because that was already done, so no problems there. But today, I want to talk about and a little bit focus on the process in which people build these models, how they're actually used, so we can understand how machine learning, AI, et cetera, is used in the field of insurance, specifically focus on life insurance, maybe touching a little bit on P&C. So just give a little bit of background and a little story going into this. about 20 years ago, I got involved with modeling and starting building out models in a little-known programming language called R at the time. Functionally, I got involved with it because I didn't want to walk so far to get to the stats computer room at my university, so I just started using a language called R because I didn't have to leave my room and I could use it on my computer. It was not used that much, but today, this language, along with other languages such as Python and to the point of SQL and others, MATLAB, have really built out a full suite of statistical modeling capabilities and really not only doing more traditional and advanced traditional modeling, but also more into different things with regards to neural networks and clustering analysis and that kind of stuff to build out full suites of analytics and testing and ability to do that. These systems are being designed so that you can literally download the files. If you know what you're doing, you could probably get up and running completely brand new in 30 minutes on a data set. It might not be the best model that you've ever built, but at least you can start in building systems. And this is how easy it's become today. So talking a little bit about the state of insurance and how we can think about those systems as they apply. So realistically speaking, it's been a huge race to digitalization. We're seeing a lot of automation happening, whether that be on the form filling out, it's in essence auto filling out features for people. It's looking at and trying to create a faster way to do the underwriting. There was a big discussion on that process just prior to me. And also less invasive underwriting. So historically speaking, they would often have to order what's called wet tests, which you would, generally speaking, it's urine and a blood sample to test for different markers to understand the risk. Today, a lot of people are looking at different ways so that doesn't happen, and also the process can be done a lot faster. This doesn't come without risk, because how does that risk change? How does that evolve? When we start changing the processes, does that change human behavior and the way people respond to it? The answer is yes, and if it does, is that better or worse for you as the insurance company in terms of the risk that you're taking on? We also need to think about the transformation that's happening in society across many domains. So not only is the machine learning coming in and different features of AI coming in to help improve the assessment of the risks, there's also changes in the inherent structure of the population and the systems at large. So as I mentioned before, we talk about full underwriting, which you have a little bit more invasive process. Today, it's happening in much more real time, much faster. Historically speaking, we had different things where we're getting information from a company called MIB or medical data, driving, credit, et cetera. And now things like avocation and voice and social media and marketing data is being used. We also have changes in the population and the risk itself. So historically speaking, we thought about smoking. That's obviously a major risk to mortality. But we've seen massive changes in obesity patterns, opioid use, e-cigarettes, things like that, which creates a different risk profile of that person than historically. And so if we think about how mortality is changing or the risk or the lapse is changing, we need to think about how those socioeconomic factors are affecting that as well. And then also, how do we think about the construction of the risk process? Whether we stick to the traditional methods of mortality tables and kind of direct adjustment factors, or we think about a much more dynamic system, which is considering more variables, complex relationships, and the interaction between that. And not just between the individual risk you're assessing, so for example, mortality, but also how that's affecting things like lapse, or maybe how that's affecting upselling opportunities. Maybe they might, as we just discussed, somebody might be in the market today for term insurance, but 3, 4, 5 years from now, they might be in the market for a whole life product. So being able to understand that person and maybe sell them early and then, again, sell them another product later is something that an insurance company might value. And you can think of this across this whole spectrum in this life cycle. And across every one of these buckets here, we can have different processes to use machine learning or to understand the risk profile. So first, in the clear thing in the middle, you need to identify the risk that you want to protect, whether we're talking life insurance or property insurance or some sort of liability insurance that was talked at the very beginning. How does that risk evolve, and how do we understand that? We need to identify the demand, who it is, so you can use tools for that particular case. Who is the person that you're trying to sell to? How can you reach out to them better? Can you create an efficient risk mitigation system, whether that be from the product itself or other features associated with the product? How can you make sure that you get the right viewership, increase the contacts? How can you evaluate the risk itself and assess it? As I mentioned before, can you upsell at a later date, or can you identify the people that might want to be upsold at a later date? And then at the end, you also have fraud detection, which was also talked about here. So can we detect maybe people who are submitting fraudulent claims or people that might be associated in that area? Can we figure out that, and can we help mitigate the payouts associated with that? So in this case, let's focus on one particular risk, specifically the insurance community, specifically to mortality risk here. So historically speaking, it was relatively straightforward in the sense of how we thought about the mortality risk, how we understood the mortality risk. And I'm not saying that this process is still used today, but we're also creating systems to try to enhance, improve, and refine that methodology. But previously speaking, realistic, you talked about a product, you talked about age, gender, and maybe some sort of underwriting class like smoking or non-smoking and preferred or not. And that was kind of all of the buckets that you worked with. Today, we're thinking about more diverse components of that, how systems and credits and debits work together, and also how can you not necessarily change the risk assessment from the person, but make sure the person that you're assessing fits into that bucket as best as possible. So there's two ways you can actually think about it: improve the assessment itself, or improve the way you bucketize people into that risk. And people's health, if you want to think about it, is very dynamic, and it crosses many different spectrums. Obviously, we have our own processes and procedures that we go through within the day, whether we eat a little bit more fast food than we should, whether we exercise or don't exercise, whether we engage in risky activities such as, let's say, driving a motorcycle, whatever the case may be. But there's also other factors that relate to it. So, for example, being married, generally speaking, has a reduction on mortality. What is obviously the family history, but not just the family history in aggregate, but specific features about your family history. And then that's really a precursor for genetic profiling. All this time when we assess this mortality risk, we need to think about what is actually can we do and what is a function legally to do in certain parts. And each jurisdiction has their own framework that they work under with what you can use and what you can't use. But machine learning models can also help and be able to identify areas of where there might be risk that's either maybe being not disclosed correctly or maybe just being omitted in the policy process itself. And that can allow you to kind of understand the person, bucketize them, or perform different assessments to make sure that you're accurately modeling that risk. So when we think about these processes, we need to think about how all of these factors interact with one another and how that risk comes together to understand that person. But we don't just think about today, because if we sell them a term insurance product or a whole life product, those are for long durations. Even a term insurance product, a short-term insurance product is 5 years, 10 years. So effectively, if we're selling that to them for 5 or 10 years, or a whole life product for the entire life or nearly their entire life, how does that mortality change over time? What happens in year 20 and year 25 and 30? Do I need to think about that profile? Maybe the person is much less risky today, but when they get to a certain age, maybe their risk profile changes. So there's different ways that we can think about this. Overall, we can use more traditional statistical methods, and I'll get into that. But when I say that, I'm more thinking of traditional regression analysis. And even with traditional regression analysis, the tools that we have today are much more complex than they were much more complex. They're much more accessibly complex than we had 10 years ago or 20 years ago. And in terms of machine learning, taking different systems, whether we're talking neural networks or others, to really refine and understand that process. But there's pluses and minuses to that. In the traditional side, it's a little bit easier to understand the relationships. You have a much more control on the functional form that you're giving the system. You understand what's happening. You are literally saying that I think that variable y is based exactly on parameters like this, like this, like this. In machine learning applications, depending on what you're using, that process is less controlled. Somewhat, maybe just a little bit less controlled, to the point of which much less controlled. So sometimes the model it builds and the systems that it builds are more complex and harder to understand. It also can potentially not find great edge cases in certain situations and create systems where the model kind of doesn't really perform very well in certain situations. So we need to understand those limitations. We need to understand why one person might use one or the other. And both systems are advancing as we have more data, but also as the tools increase and the capabilities of those tools increase. One of the big things that I want to point out to people, you can almost think of it in a couple different domains when we think about modeling of with AI or machine learning. You have the capabilities of the person themselves. What's their skill set? How deep do they actually understand that? How well do they understand how to use the tools? You have functionally how inventive, for the lack of a better term, they are with those tools. So they can understand the tools very well, but if they're not overly inventive, then there's a limitation there. But then lastly, there's also the data aspect of it. What kind of data do you have? How much data do you have? How good is the data that you're using actually to what you're trying to assess in its application in the future? So those are three areas, and you really are trying to improve across all three of them. So taking consideration traditional and machine learning, here's two diagrams of what people will often refer to. On the left-hand side is traditional. They might refer to this as regression, multivariate regression. Sometimes you'll say distribution fitting. That's a little bit different, but that falls into traditional statistical methods. And this is effectively a form. You have y is some function of other variables x or x1 and x2, etc. Machine learning, this is a simple machine learning model here, but effectively you have your input data, which is the first thing on the left-hand side in that diagram, and then you might have these kind of hidden components to it, the hidden layers. And the way that the data is getting modified and adjusted is combined and assessed, is getting aggregated, modified, refined, and then creates an output. It can be a single value or it could be a set of values. That process iterates through and improves over time based on the information that you have. So you have these two different diagrams. Oftentimes, you'll hear people refer to machine learning or artificial intelligence relative to the brain, because what we think of is you have your complexes that are happening in this system are somewhat akin to how you think. So effectively, when you're driving a car, you're going to go down the road, and if it's sunny out or it's rainy out, it's going to change the way you drive. If other people are being aggressive on the road, or maybe they're just maybe not being aggressive, it's going to change the way in which you drive, and this all happens in an instant. You build upon that. You learn as you get older how to maybe drive a little better, different conditions, how to be maybe a little bit safer, and that trains your brain and how to actually interact and train with this. It's similar how you can think about the data. It refines every new data element it uses, it improves the estimate, refines the answer, and then tries to improve the assessment over time. Going back to a little bit on the traditional side here, but using models, we really advanced even in the traditional sense. So historically speaking, I had mentioned a few different ways we thought about the risk profile, but really mortality assessment in particular, and this is true for many different areas, really only used a variable, two variables, maybe three at the most in its assessment. And those uses of those variables were pretty straightforward. There wasn't a lot of complexity. We often didn't think about the error associated with it. It was, this is what our best estimate is. This is what the average says. Let's use it. Correlation really wasn't well understood or used, partially due to the lack of systems and tools, partially due to just many outside variables and just didn't have the data for it. Today, even within that system, we're getting much more complex. So you can see the picture of what mortality functional form might have been at the top. Today, even a simple model is using much more complex and dynamic variables, where we're using different transformations of the properties. So, for example, you can see x squared, or you can see the log of x2. Alternatively, we're even seeing things where people are using different things like PCA, principal components analysis, or subregressions, in which they are trying to decorrelate variables amongst them. So, for example, maybe you want to use some sort of predictor with regards to the socioeconomics of the people. Well, oftentimes socioeconomics is correlated with many different types of variables. So income is correlated with smoking, and that's correlated with obesity and diabetes and things of that nature. And so if you really want to understand each variable, you really need to try to decouple those interacting risks. But to that same extent, we can also use a neural network. And what we would do here is we'd feed data into a predefined form, in this particular case, and create adjustment factors for each of those variables. That would then allow us to create composites of variables, different sets of interacting variables. And what this does is it allows different variables that may interact with each other combine to create unique profiles of the mortality that have patterns that are hard to distinguish with traditional techniques. The system is learning and trying to constantly improve those patterns. And when it does that, it creates better estimates and better refinements to the error. And then it tries to mitigate that error estimate as best as possible and does this over and over and over. You can almost think of this, and more than just almost, probably the easiest way to think of this is a giant guess and check that the system is doing constantly to try to improve those refinements. Now, that system isn't the only possible one. There's many other types of things. So we just kind of talked about a feed-forward neural network. There's also different types of neural networks. There's recurrent neural networks, where the input parameter is also the output parameter, and it's constantly as a feedback loop. And we see this come up into many different things. One example would be upselling of a type of policy. So in essence, the way that the person interacts with the policy, the way that they respond to the policy is changing based on what is happening. You can imagine a situation where one person's interacting with it, and as I give that person different pieces of information or different benefits, that changes their response back to me, and that feeds back into the modeling framework. So almost it's trying to model that kind of interaction process amongst all of the different variables. We also have from a recurrent neural network. There's also different things in the system where we're also kind of expanding beyond this, where we're using the models, and it's actually a little bit touched upon before in terms of identifying smoker probability. So in many different states and countries, there's only a handful of information and pieces that you can use to identify if somebody is a smoker or is not a smoker. One of that being through generally what I refer to as wet tests. Another one where the person admits to it or doesn't admit to the fact that they are a smoker. There's a few others in different jurisdictions. But that does not mean that we can't try to understand the risk pre or during the processing. So we can use different types of tools, such as a voice, to understand, is the likelihood of this person being a smoker greater than the average? And so you can think about this. If you think about maybe a family or friend who is a heavy smoker and maybe been doing it for a long period of time, the vocal cords in that person are different, generally speaking, than a person of their similar age and sex and other sociodemographics. So what the system is trying to do is just trying to assess, given the vocal cord and the impact and the kind of the deterioration in the vocal cords, whether this person has a higher probability of being a smoker or doesn't. And that can allow the underwriter or whomever to kind of use that and to reassess or to maybe dive deeper if that would flag the person as being a higher smoker probability. As I mentioned before, there are jurisdictions and limitations to this. So often this cannot be used to actually say that you're a smoker or not a smoker, but it can inform the underwriter, say, you might want to take a deeper look at this particular person. Or alternatively, you can look at your past policies that you wrote and identify how good of a system or how great was your overall detection of smoker and non-smoker relative to what we would have estimated. And as I mentioned, there's many different features and forms and use of this, but we can actually create a holistic system on this in the modeling and the process. So you can think about the start of building initial conditions to create a mortality assessment. So whether we're using a neural network or GLM, GLM stands for General Linearized Model. Alternatively, then we might want to market this and assess who's the ideal risk that we want to present this to, or maybe who's most likely to buy this, because there's obviously a cost associated with that marketing, and I want to pay as little money as possible to get the biggest bang for my marketing dollars. Use models to identify individuals who have maintained health. So some people might be healthy today and all of their biomarkers are healthy today, but are they going to be healthy 10 years from now, 20 years from now? You want to use tools to identify that. Maybe they're just not in a great trajectory. Maybe their habits are okay for now, but they won't be as they age. And then we also need to understand block of business that we're looking at. And things like providing additional gifts, memberships, etc. So there's some insurance products out there that try to invoke a response by the participant by offering different things to them. So whether that be in the form of a gift or more insurance or increasing their insurance coverage or different things of that nature. And they effectively are, in quotes, free, but the policyholder usually has to do something to get that, or at least maintain certain metrics to get that. And this is a way to kind of increase the response by the policyholder, increase the value that you're giving to them, but also potentially decrease or better price the risk overall. There's other systems that we use in particular, and genetic algorithms comes in play often with regards to portfolio analytics in the life insurance space. There's other areas for it, but one of the major areas that is used is portfolio analytics. So if we imagine here, an insurance company isn't really just thinking about the one policy they're writing, they're thinking about the thousands or tens of thousands, 100,000, millions of policies that they're writing. On top of that, a company like a reinsurance company isn't just thinking about the one contract that they have with the insurance company. They're thinking about all those interacting contracts. So if you imagine this space here is the risk to the reward that the company is getting, we can plot all of the different options of the company and create an efficient frontier, or a theoretical efficient frontier. Maybe the aggregate policies create the profile that you see there. So overall, the risk to reward is this red dot, and it's a composite of all the different dots underneath. But this isn't the actual best profile that somebody can create. This is just the profile that they currently have. Anything in the purple triangle is quantifiably better. It's either more reward, less risk, or both more reward and less risk, given the inputs and the variables. So we want to get to the frontier as best as possible. And so you can think of this, one of the good examples to think about this is a life reinsurance company. Maybe they have about $3 billion to invest. Maybe in a given year, there's 1,000 contracts that they can invest in or put their money on or back different types of things. Each one of those has its own price, expected return, correlation with other policies out there. And what we want to do is derive the best investment portfolio. So previously in 2000, when these kind of tools weren't well known or well used, or at least not well used in the insurance market, a lot of the ways to do this was to kind of define risk tolerances by segment. I only want to take up to $1 billion of life insurance risk and $1 billion of annuity risk and $1 billion of group coverage, whatever the case may be. You might define rules of acceptance or an accepting a risk. So effectively, I will only accept a life insurance contract if it meets the following characteristics. And then at the same time, there was still that businessy aspect to it. And what you try to do is identify relationships and firms that just do better overall. And so you can kind of rely on that backing. Today, we do a mixture of that, still exists today, still very important, but with genetic algorithms and other covenants. So a genetic algorithm, you can imagine as this picture on the lower left-hand side and what it's trying to do. All of the different ways that you can invest your portfolio exist somewhere in this space. The problem is that the number of combinations that you could possibly have is so great that it's just not solvable in a reasonable amount of time, or potentially not solvable at all given our current state of computations. And so the number of combinations that you have is very large. Even in this example with 1,000 contracts, if each contract was only a buy or sell option, not even a participation amount, which is what most contracts have, it's just buy or sell, the total number of contracts is 2 to the power of 1,000, which is extremely large number. And having a computer try to compute all of those different combinations would be impossible, presumably in the lifetime of our lives. So what you do is you sample through the space. You sample through all of these different combinations, and you pick different things. And as you sample through that, you build better investment returns and worse ones, but you keep the best ones. And when you find those best ones, you say, okay, I think that there's something better around this area of profile. Let me sample again. And you do that again. And then you do that over and over and keep the best and keep the best and keep the best of all the different samples that you created. And that usually is called a steepest descent or steepest descent type modeling. And when you get up to that, you might find a point where you can't find a better one, or at least not. The improvements are very minor at this point, and you find what's called a maximum. Now, often it could be a local maximum, or it could be an absolute maximum. So you might sample, and what you can see here is you might be climbing this chart, and you get to the top, and that would be an absolute max. That's the best performance portfolio that you can get. Alternatively, you might start sampling over here, and you get to this hill, and that would actually be a local maximum. You don't know which one you're at until you're there, but effectively that's what that is. These allow for people to take that same portfolio and refine it so that we can move that red dot out closer or onto that blue line. And so that allows us to improve the investment profile and the risk selection so we can end up in a much better position long-term and overall. And here's an example of actual data from an actual portfolio where we're doing just that. We're on the left-hand side here is the expected return from the profile. On the bottom is the risk measure that we're using. And the initial portfolio started somewhere around this red dot. But all of these blue dots that we simulated would actually have better returns for different levels of risk than what that red dot would be. And so we can see that we really want to probably be somewhere out over here in this yellow area. And these are specific portfolios that are attainable, that are given the selections that are available. So you can improve investment return. So in this particular example, the improvement to investment return was somewhere around $70 million. So going from about 400 million to 470 million. So that's a pretty big uptick. And actually a reduction in the risk estimate and the risk tolerance. So the takeaways here that I just want to comment is machine learning is already changing insurance, and there's really no signs to slow down. I mean, it's changing the broader market in general, and insurance is no different. The life insurance applications are helping us rethink about the risk, helping us think about marketing, risk assessment, improvements, policy assessment, etc. And the value of AI will continue to grow. Currently, or I should say 2018, there's about $1.3 billion in the life insurance space alone. That's expected to grow in the next couple of years to $20 billion. So we fully expect this expansion of this, the use of this across the market segment. So with that, I would love to open this up for questions. Thank you very much for your time.
Thank you, Doug. Thank you. I think it was a lovely presentation and it showed how machine learning is transforming the insurance industry. Thank you. And the figures, key takeaways which were there in the last slide, excellent key takeaways. Yeah. $1.5 billion to $20 billion.
Large growth over the next couple of years, yes.
Yes, absolutely. Thank you. We'll wait for 1 minute for any questions. If anybody want to ask from each speaker side as well, if anybody you have any questions to each other, you can also ask before we close for the day, and I'll give the closing comments. So I think if no question is there, we can just try to wrap up today's conversation, and let's try to close. So any closing comments from any one of you before I give my closing comments?
I would say embrace. Yeah, go ahead.
I think it's an exciting time for artificial intelligence, but it's seen from a claims and underwriting perspective. It's the policy that matters.
Yes, absolutely. It's the policy that matters. Yeah, Doug.
I would say embrace machine learning and artificial intelligence and the rest of that. Just be mindful that as you use these tools, it's like you're getting in a race car, much faster, much more precise tools and systems, but they are very risky. I shouldn't say very risky. They need to be done with precision as much as possible. So
I think as a human being also, when you are taking the policy, you have to be sharper. You have to be conversant with what is going on. Correct. Yes. Because there will be chances that machine can give you different things which you cannot think of. So which happens in a physical space or in a pen to paper format. A lot of things are. Frederick. Yeah.
I have a quick question for Doug.
Yeah, Frederick.
Are you a Formula One fan?
More in motorcycles and the TT races and that kind of stuff. So, but I went with Formula One and in NASCAR and that kind of stuff. I thought that would be a little bit broader of the topic, but yeah. Racing in general, yes.
Good. So Frederick has a sharp mind. He can see what is there in store. What each one of you offered. That's what experience speaks for itself. Yeah, Craig, anything, closing comments which you want to put? Craig, I think you are on mute. Yeah.
we are already down the path. There is no going back. It's as we've said, it needs to be managed, but it has the potential to make our business, which has been a laggard, unfortunately, in terms of technology and digitization, into a leader. Because if we don't do it, then we will become Amazon Life.
Absolutely. Rick, are you there? If you are there,
I'm on. Yeah.
Okay.
So I think the only comment I would make is do pay attention to cultural transformation. AI is as much about technology as it is about evolving the culture of the users who would benefit from the technology. So I think if your organization is relatively new, you are looking to go deeper, to pay a lot of attention to that. Once you have the right culture in place, the innovation just happens.
Absolutely. Thank you, everyone. I think it was a lovely conversation and lovely thought process from all of you. And so just to wrap up, we'd like to thank all our technology partner Digit7 and all our community partners, speakers, and attendees who came together for enriching knowledge through this forum. There was a technical glitch and there is still a technical glitch. That's why many of the people didn't able to join this conversation. We are working on this. Anyways, this all conversation which we had was recorded. It was on YouTube and of our channel as well as on Facebook channel. So you can obviously share it and you can see it a number of times whenever you get a chance. Today's event obviously gives us a lot of information about AI, about how technology, AI, machine learning, deep learning was transforming, is transforming, and is the future for the insurance industry. So lastly, please log on to our website and like the social media channels. We'll be sharing lots of knowledge, sharing topics, details, announcement of next events, and much more, which will help you register and attend the same. As I told you initially, the next months are very crucial what we are organizing. We are having very quality speakers for those events as well. Like we are having manufacturing, how AI is transforming manufacturing sector. Manufacturing itself is a very big industry altogether. Then we have how AI is transforming the telecom sector. How marriage of IoT, AI, and blockchain. This is also a very important topic, which we have kept it for the December month. So hope to stay connected. All of you have a lovely day ahead, and let's see you in our next events as well. Thank you, Frederick. Thank you, Craig. Thank you, Doug. Thank you, Rick.
Thank you, everybody. Stay safe.
Stay safe, guys. Bye.
Take care. Thank you.